Welcome back to the channel. In this video, I want to get into Meet Kevin liquidating all his market positions, which is set to be around $20 million. I want to discuss his strategy, what I think about it, and is this something that one should consider as well, or is this specific to him? So he talks about that because of basically the classic examples of why the market is falling now: rising interest rates, quantitative tightening from the Fed's uncertainty, rising inflation that's kind of leading to all this, the amount of money supply that was in the system that's now being backtracked, the savings rate and possible recession, the decline in spending power, and kind of all of this leading to the fear in the market, which is creating a huge crash as we see, especially in growth stocks, because growth stocks are typically valued higher, and when there is less money and it's also more expensive to borrow, then these stocks get hit hardest. So I would say that it's not like Meet Kevin was looking out a few months back and looking at the market and seeing all these trends and selling out. It seems like he is right now selling out already when many positions, and I know a lot of his positions, are down over 50%. So he is capitulating, definitely not at the perfect moment where he can then look back and be like, wow, I nailed it. Now, if the market does go down 50% and he doesn't buy back until then definitely has the ability to look back. But for now, it seems like he's capitulating to a market that has already taken a massive beating. So I want to get into why he could take this strategy and why I would say many shouldn't. So first, it is important to understand your financial position comparable to his. So most of us don't have $20 million that we pretty much are wealthy at this moment, and we can take our money out of the market, and worst case scenario, we put it back at a later time, even when it's higher, but we kind of are already at the point where we can kind of have that financial freedom. I am at the point, and I would assume most are at the wealth creation phase of their life, and in order to create wealth, typically the market and equities are the number one way to do that. And in order to do this, you have to be in the market. And timing the market, and you have to time the market on the one hand when to get out, which we see already he didn't get out at the right time. And the second is also timing the market of when to get back in. And that's usually even harder to do because then it just keeps on dropping and emotions get involved and you don't know when to get in. Next thing, and usually when the market comes back, it's at least the first 10% is extremely quick, and that's a very hard thing to do. And if we really zoom out and look at the market, even with all these downturns, we see where it came from, where it's going today. Innovation is still at its beginning phases. I don't think the end of the U.S. economy is here. So I think that when if you're really in that wealth creation phase of your life, it's a very big step to take and decision to make to just get out of the market and take that risk of getting back in at the right time. Now, there are ways to go about it, which we'll get into in terms of having cash and dollar cost averaging and being in good positions, but you have to understand where you are comparable to a guy like Kevin who has already kind of made it, you know, and worst case scenario, there's other investments he can make, buy real estate. I mean, he already has, as we're seeing, those $20 million. So that's the first thing to take into account. My second point is more of a lesson, and it's really about investing in just hype stocks. And this means you're just investing in a stock because of all the hype, because it's going up, because it's an industry that sounds incredible, and you put your money there. And I don't mean overvalued stocks in the sense of many growth stocks are overvalued, but at the end of the day, if you can look at their financials and be like, in 5 to 10 years, this is what revenue and profits they'll be doing, which if we discount it today, it makes their stock price, even though look overvalued in the typical value metrics, it is still considered value, then that I'm fine with. I'm talking about a hype stock and overvalued in the sense that if you look out 5 to 10 years, you have no idea if it's actually going to survive, if it has the money to not go bankrupt, if the industry is actually for real and the competition within it, and do they have a technology that's actually sound and better than competitors or companies that would get into it. And this is what I mean by it. A lot of stocks have really gone up because of this hype and because the market had so much money in it and all that. But the problem is right now we're at a point where the market is crashing, and a lot of these stocks already crashed like 60%. And you have to look back at the dot-com bubble. A lot of stocks that fell 90% or 80%, a lot of them stayed down because they were these overhyped stocks that really didn't have fundamentals backing them going forward into the future. And people lost a lot of money. And you can't just look at it and be like, okay, the stock is at was at $400. Now it's at $100. So I'm just going to dollar cost average because it has to get back there. No, you have to look at a company from today, seeing what is it going to be in 5 to 10 years in terms of its revenue, its profits, its margins, and all that. And if you get to a point that it's very undervalued today for what it's going to get to, then you can buy it even if it doesn't fit within the value metrics. But the problem is, I think there was a lot of hype stocks, and even Kevin, he was in a ton of these hype stocks. I mean, when I really like him, I really do, and I watched a lot of his YouTube videos, but a lot of the stocks that he did invest in, and again, he has this money that he can throw around, and I'm sure it's smaller amounts that he put in these stocks, even though it looks like those are the ones we want to jump on. I'm sure most of his money was in Tesla-like stocks, but in these stocks, there was money, and a lot of them were hype. And if you look 5 to 10 years from now, could you know that this is going to be a company that's ultimately like Matterport going to dominate the metaverse because of their printing and 3D printing and all that? Like you can't really know that, and that means that there is a possibility that these stocks could stay down for longer term. And because you'll be uncomfortable with those positions, you might very well sell at the worst times. And this is why it's important to, before ever buying a stock, whether the market's going up and down, you want to look at do your own due diligence, your own research, and kind of look forward and understand the revenue and profits that specific company will come in, no matter what industry and how sexy it looks. It needs to come down to those fundamentals. Even if it looks overvalued today, you can still buy that stock. But because you found out that through your research that in 10 years it's going to be a certain thing. And I think this is a really, really good lesson, because, I mean, if we look at the dot-com bubble, Amazon, even if you bought it at its highest, then it would still be up over almost 4,000%. So you're still able to be in just really good companies, stick through this time in those companies, but they have to be that you see that kind of future beyond all the noise. And I really believe you're in the right mindset when, I mean, it's always going to be hard to see the stock market falling the way it is, but there's a difference between it being hard to see and just like every day is kind of, you know, another one of those days, or you're freaking out, you don't know what to do, you're lost. That means that you weren't in for the right reasons, and typically it means you have to kind of go over your strategies. And really the mindset should be, okay, you're in great companies, and you're in them because you believe in 5 to 10 years this is what their revenue and profits are going to be like. And right now that the stock is falling, I mean, you look at the companies again, if there's a recession, there could be a short-term hit to those companies' financials. But ultimately, in 5 to 10 years, those companies' financials stay the same, which means, okay, I get to buy this stock at a discount. Or it just, if I don't have money right now, it just doesn't matter because I know where it's going to be in 5 to 10 years. And when this starts becoming your mindset, then you know you're in it for the right reasons, and you're kind of in the market in a healthy way. And we have to remember that one of the biggest advantages to retail investors is that, comparable to hedge funds and typical portfolio managers, is that we have time, right? We don't have clients that are calling us and being like, we're going to take our money out if we don't do good this year, or what's going on with the market. Like, we have the ability, or at least if we're younger and we're not planning on using this money in the near future, because then the whole other strategy should be there, which I'll discuss in a minute. But we have the time to invest and really think about that future, and all this short-termness could be opportunities, but it comes down to, again, the last point of the stocks that you're really getting into and doing that fundamental analysis behind them. And then it takes me to the last point where I want to talk about some strategies. So I would say, if you're young and you have a long-term investment horizon, then you want to be in equities. I mean, bonds almost give you nothing, but you want to be in good equity. So if you are new to investing, you don't have that much ability to do research and all that, then maybe it's better to, for now, be in ETFs. You know, you can buy the index. You can, again, zoom out, look at the market, look where it came from, look where it is. And even with all these drops, 2008, 2087, like, these drops happen, but the market typically comes back. I don't think it's the end of the U.S. economy. So in my personal opinion, not investment advice, I do think it will come back. So you can kind of just be in this index, and it is more... it is safer to do that if you're newer to investing and it's hard to pick stocks. If you are definitely better at this, at picking stocks and all that, then maybe it's good to diversify, pick some good stocks that you like in good industries. Remember, not the hype. And if you are, the next level is if like you have real high conviction on specific stocks and all that, which this is more how I invest, then I invest in a lot smaller of a portfolio, not so diversified. But again, the research has to be so sound in order to, because at the end of the day, one company could just kill you, right? Or 1 to 5 companies if they don't do well. So I really think that we're in a period of uncertainty. The market very well could keep crashing. Monday could come and it can start going up again. No one really knows. Ultimately, you want to be in it for the long term, especially when you're in that wealth creation phase. I'm sure we will come out of it. And it's usually the people who sell at the bottom, who sell out of emotion, that get hurt the most. So thank you all for watching this video. Please like and subscribe, and I will see you in the next video.